We are live.
Good evening, ladies and gentlemen. Welcome to this webinar of MeritorQ Advisory Portfolio. I'm Alok Nangalia and I'm part of the Client Advisory and Relationships team. I have with me Krishnan VR, who heads the research function for our quant offering, MeritorQ. The agenda for today's session is to understand why periodic rebalancing, or as we call it, refresh of the portfolio is important. Krishnan will help us understand how rebalancing compares versus buy and hold strategy using same sequence of rules as in MeritorQ. How rebalancing makes MeritorQ more dynamic, and why semi-annual rebalancing frequency is optimal for this strategy. Once Krishnan completes the presentation, we will have the Q&A session. You can type in your questions in the box on your screen during the course of this webinar, and we will try and answer as many as possible across this presentation. With this, I request Krishnan to take the floor and help us understand the importance of rebalancing. Over to you, Krishnan. You're on mute, Krishnan.
I'm really sorry. Good evening, everyone. Thank you for your time and attending this another edition of Marcellus MeritorQ Webinar. Like Alok said, we will be discussing rebalancing, which is one of the very important steps in Marcellus MeritorQ. So, without much ado, let's just directly get into the content. So, before we get into the today's discussion, maybe a couple of points just from a disclaimer front. One is, please note that whatever we discuss today are for your illustration and understanding only, and do not guarantee any future returns. And also, please note that investment in securities are subject to market risk, and you should read all scheme-related documents carefully before investing. Now, before we get into the utility of rebalancing in MeritorQ, give me just a quick recap again for what we are doing here in MeritorQ. So the broad investment philosophy in MeritorQ is to buy good quality and profitable companies, but which are undervalued. So we are looking at undervalued but profitable companies. We measure undervaluation by comparing price or the available price of the company with respect to its free cash flow generation ability. Now, this we had discussed in last month's webinar, just to refresh for people who had attended last month. We again follow the sequence of steps. Again, I don't need to go, I'll not go through this sequence again. We have discussed this a number of times, but again, starting from the universe, we apply the forensic screen, the leverage, and the consistent profitability screen, and then we select basis both valuation as well as profitability. Finally, the position sizing is basis the price to free cash flow, which is again valuation, i.e. companies which are more undervalued get a higher allocation in the final portfolio. So with this 30 to 40 stocks, we repeat this portfolio construction process once in 6 months, which we call as rebalancing. Rebalancing in MeritorQ happens as of the first trading date of April and October every year. So these are fixed calendar dates on which we do this rebalancing. Once you subscribe to this strategy on small case, so we will be doing a demo on how you can access this product on small case today. But once you subscribe to this product on small case, you will get a notification on these 2 dates: the first trading date of April and October, when this rebalancing is due. And once you follow the instructions, this rebalancing will be executed per advice through small case, and the new portfolio will automatically get updated in your DMAT account, right? So that's the construct and where the rebalancing comes in. Again, like Alok said, we will be doing a small demo at the end for viewers who are not sure how to access this product on small case. Moving on, so rebalancing again, just to take a more a general, just to get a more general understanding of why we are doing rebalancing, what it means. Rebalancing can be understood as a realignment of the portfolio to restore balance, right? So for instance, we have frequently heard that it is important to vary one's, the kind of food we eat, per the seasons or the weather conditions, right? So, I'm sure a lot of us would have got this advice that during summer, you should go heavy on water. You should consume more water. You should consume more roughage, and maybe cut down on fats and carbohydrates, right? Whereas during winters, you may want to do the opposite, essentially consume more fats or carbohydrates. So again, this is again meant to be a good health advice, right? So that again you can vary your diet per the requirement of the season, right? So if you think about it in a similar way, rebalancing or this periodic portfolio refresh, does something similar, right? It helps you or helps the investment strategy. Again, the investment objective which we are targeting in MeritorQ, which is to buy good undervalued companies. It allows this the portfolio to remain true or to be aligned with the core investment objective or this investment strategy, right? So and rebalancing, by the way, of portfolios is more common than than one would presume. For example, intuitively, if you think about it, investors do load up on securities, which have witnessed a sharp fall. We saw examples of this during the Corona crisis, where the markets went through a significant correction, right? So,
hi Krishnan, your screen is freezed.
Are you able to hear me? Because I can hear you very clearly. Hello?
Yes, I can hear you, Krishna.
Okay, shall I continue or?
Yeah, please continue, Krishna.
Okay. So, what I was coming to say is, rebalancing is, intuitive, right? A lot of investors, do rebalancing anyways, in some ways, because it's, as soon as the market crash happens, that, you need to probably, buy more, stocks, or need to load up on equities just to benefit from the the correction that has happened, right? So that itself is some kind of a rebalancing, right? If you think about it, right? And of course, the reason why we are doing that is obviously to benefit from this whole dynamic of buying low and selling high, right? But again, rebalancing, despite all this, people think of this as a one-way street, right? Where higher churn is equated with higher cost for investors. Of course, it's higher cost, but not rebalancing again during this investment horizon, right? Or especially for a strategy like in MeritorQ, you run the risk that you're drifting too away or too far off from the investment objectives and not reflecting the current information, right? Which is what we want to do, and that's really important, especially in a strategy like MeritorQ. Now, of course, we understand the costs, of higher churn, which is higher transaction costs, taxes, and all of this can obviously be a drag on compounding of returns, right? So in a way, rebalancing is all about balance, right? So if and that's what what we try to achieve here in MeritorQ. With the semi-annual rebalancing we have, right? Whereas on one hand, we want to enhance the returns or to get the benefit of rebalancing, while at on the other hand, we say that we don't want to incur the additional cost, the transaction cost, taxes, etc., which comes with rebalancing. So in a way, if you think about like this, rebalancing in this context, you can think of it like a pungent spice in your food. Put too much of it, it can ruin the taste. And the analogy there is the cost from the higher portfolio turnover, but if you don't add it at all, the food will taste blunt, right? So again, the disappointment of lower portfolio returns, right? So you need to have rebalancing with just the right amount of. Okay, so to just to understand why a frequently rebalanced portfolio is beneficial, let's look at a counter case. So what we have done is, we've just taken a buy and hold portfolio, again, created basis MeritorQ's portfolio construction rule, which we talked about on slide 3. And what we do here is, we create a portfolio and we don't touch it at all for a certain period of time, right? So we did this over, say, a 3-year time horizon, and also over a 5-year time horizon, right? So, for example, for 3 years, let's say you invest in a 3-year duration portfolio, hold it for the entire duration, and then liquidate your investment at the end of the 3rd year, right? Now we created all possible combination of this 3-year buy and hold portfolio, starting from September 2006, which is the graphic which you see on the right side of this slide, right? So, so the first portfolio we created from September 2006, it goes all the way till March 2009, which is the first 3-year-old buy and hold portfolio. And then that portfolio again, we create another 3-year buy and hold starting from September 2009 to March 2012, right? Now, this is again not a unique portfolio. Again, you can have a 3-year buy and hold portfolio with a different starting date, right? So we start from March 2007, right? And then you hold it to September 2009, March 2010 to September 2012, essentially creating all possible combinations of your with different starting dates for your 3-year buy and hold portfolios, right? Over this full backtest period from July 2006 to September 2022. And we repeated this exercise even for a 5-year holding period. Why? Because someone might say my investment horizon is not 3 years, 5 years. So we redid this exercise for someone with a 5-year investment horizons. We did it with 5-year buy and hold, right? And then we took an average across all these portfolios, right? Essentially taking an average of the returns, average of the risk, and average of the drawdowns and other portfolio characteristics, right? And these are the numbers which we have summarized on the table on the left, right? Note again that these are again all backtested numbers, right? Starting from March 2011, because again, once we construct the portfolios again to have a common starting date, we started everything from March 2011, right? Because again, like we are starting from 2006 to the first 5-year buy and hold portfolio, the results will only be available from March 2011, right? The common starting date. So March 2011 to September 2022 are the results, what you see on the table on the left, right? And these are all averages, just to emphasize again. And what you can see here is, if you just look at the buy and hold returns, whether it's in terms or whether you look at it 3-year buy and hold returns or 5-year buy and hold average returns, those returns as well as the risk-adjusted return, they are much inferior compared to the risk-adjusted return or even the returns of the rebalanced strategy, which the back-tested MeritorQ strategy we are talking about, which is rebalanced semi-annually, right? So whether you look at it in terms of returns, risk-adjusted returns, drawdowns, a rebalanced portfolio has a superior portfolio or a superior characteristic versus a buy and hold portfolio, whether you buy and hold over 3 years or 5 years, right? So this again goes back to the reason why rebalancing is important, right? And again, when we are stating these returns on the tables on the left, please note that these returns are before fees and transaction costs, but they also do not assume any reinvestment of dividends, right? So how does this rebalancing enhance portfolio returns, right? Since we select and allocate more to relatively undervalued companies in MeritorQ, the returns for the strategy are partly driven by investing from the reversion to mean, right? So once you buy cheap companies per price to free cash flow, essentially you're expecting some of these companies, because the undervaluation is temporary, remember, because of all the screening rules we have, whether there's a forensic screen or the leverage screen or the consistent profitability screen, essentially we are ensuring that this undervaluation, which is with respect to the free cash flow, whatever we are seeing, this is a temporary undervaluation. Essentially, these are good quality companies, right, which are available cheap. So once you buy them, you expect these companies to revert to their the price of these companies to reflect their free cash flow generation ability. When that happens, right, so you essentially benefit as investors from the price appreciation of these stocks, right? So that's the reason. What you see here is the benefit of rebalancing shines through when you compare it with a simple 3-year or 5-year buy and hold portfolios. I will get into some of these details in the subsequent slide. Okay, so we looked at the the comparison of of MeritorQ versus the buy and hold 3-year or 5-year buy and hold. Again, when you think about the benefits from rebalancing in MeritorQ, you can break it up into three, essentially 3 points. One is it reduces concentration risk. Secondly, it allows you to reflect any change in fundamentals. And thirdly, it allows you to benefit from the mean reversion in price to free cash flow multiple, which we talked about in the previous slide, and invest in the next set of undervalued stocks, right? So rebalancing is not just a tool to or a way for us to improve the or enhance the returns, but it also functions as a risk mitigation tool, right? It is really, really important, right? So people generally think about people generally ask us why rebalancing is even required. So these are the key reasons why rebalancing is required in MeritorQ, right? Of course, in the previous slide you saw why rebalancing, how rebalancing helps you, versus a buy and hold. Here we will talk about how rebalancing in itself, right? How it helps in not only enhancing return but also in reducing risk. So, coming to the first point, which is rebalancing allows you to reflect change in the fundamentals, right? So when you think about a company's worth or its intrinsic value, it is the company's intrinsic value is best understood by how it's not by how share price has moved, but rather by its ability to generate and sustain free cash flow in the future, and its ability, its profitability, its the reinvestment in its business, and the longevity of the business, right? Essentially, the sustainability of the business. In fact, empirical evidence points to the fact that over long run, stock prices are driven by company fundamentals. So stock prices are slaves of the company's fundamentals, right? And reflecting the current fundamentals of the company in the portfolio construction process is absolutely essential. So in MeritorQ, we use a set of fundamental screening steps. The first 3 steps, which we have talked about repeatedly, these are all based on fundamentals. So basically, if you think about a forensic screen, we are looking at a set of 11 ratios, right? For non-financials, around 10 ratios for financials. On basis of that, basis those ratios, we are saying whether the company, it's cooking its books or it's manipulating its earnings or not, right? Similarly, when you come to the a leverage screen, again we are looking at the debt to equity of the company, and coming to the consistent profitability screen, you're looking at the historical profitability of the company, whether it has been consistent over the last 3 or 5 years. So all these screening steps are based on the fundamentals of the company, the fundamental financials of the company, right? Now, just taking an example of just taking an example of how rebalancing allows you to reflect any change in fundamentals. For example, Procter and Gamble, right? So this was part of the portfolio in 2021, right? But in 2022, what we saw is the company could not pass the forensic screener, right? And this was because it had fairly poor free cash flow conversion. It's what we also found is it was not reinvesting enough versus its own revenues, and the volatility in income, other than the income that's generated from its core operation, is also quite high, right? And there were other problems like for example, how efficiently the company sweats its assets and so on, which resulted in the company being cleaned out in 2022. So P&G, even though it was part of, it had cleared our forensic screener in 2021, in 2022, it was no longer part of MeritorQ, the back-tested portfolio, right? So another screener which we use is leverage, right? Where we eliminate company, like I said, with high debt to equity. The case in point here is the Fontaine-Reeves Consumer Electricals, which got screened out in 2022, even though the stock was, made it in the portfolio in 2021, right? And the simple reason here was that its debt had more than tripled from 480 crores to 1600 crores, right, over this period. and its debt to equity consequently went up from 0.3 times to 0.7 times, right? All this happened from 2021 to 2022, which is what you see on this slide. So we have actually showed you how the fundamentals of the company have changed over time, right? And how it gets reflected in the actual allocation in the portfolio. So what you see on this slide is essentially, the red line shows you the debt to equity level of Crompton Greaves Electrical, right? And we have shown you this entire chart over the period in which the Crompton Greaves Electrical was part of the portfolio, and to the point in March 2023 where it completely exits the portfolio. And you can clearly see how this is happening, right? So the debt to equity of the company drops, so it makes it through into the portfolio. It's undervalued, it's profitable, so on and so forth. The weightage increases in the portfolio. But subsequently, as soon as we get the debt bump up, right, or the debt to equity increases in September 2022 rebalancing. As soon as that happens, because the new financials of the company are available, right, for FY 2022 by in the September 2022 rebalancing, it gets reflected, and the weightage goes down. So immediately in September 2022, the weightage of Crompton Greaves Electrical goes down because its debt to equity has gone up. Right, so debt to equity is the red line, the weightage is the dotted blue line, right? And in the very next rebalancing in March 2023, Crompton Greaves gets thrown out of the portfolio, right? So this is again, the importance, or reflecting the fundamentals in action, right? So rebalancing literally in action. Again, when you talk about fundamentals, please note that the complete fiscal March year-end financial data for most companies is available by. So again, we are looking at 500 odd companies. Remember, that's our investment universe that gets available. For almost all companies available by end of September. So it is reflected in the September end or the first trading date of October when we do the rebalancing. The second rebalance, which we do in April, exactly 6 months later, mainly considers the changes in relative valuation. So that doesn't consider any change in fundamentals. It's primarily to reflect change in the relative valuation basis price to free cash flow. Now, coming to the second benefit of rebalancing, which is excessive concentration, reducing excessive concentration. So excessive concentration, when we say, it's basically concentration risk, right? Essentially over allocating, to certain stocks in the strategy. And obviously excessive concentration in a rules-based strategy like MeritorQ is risky because unlike discretionary strategies, right, we don't have the leeway to reduce exposure to, the more over allocated stocks if an adverse event happens. Right. In MeritorQ, also remember that undervalued, overvalued stocks, also have their. So the way this rebalancing helps in MeritorQ is because of the two reasons, right? First of all, we are selecting basis valuation. So as soon as the stock becomes overvalued, there is a higher probability that it will be removed from the portfolio. Also, once a stock becomes overvalued, relatively overvalued, it will have its allocation reduced because position sizing is basis valuation, right? So, rebalancing mechanism, right, essentially acts as a automatic check in a way, so that you're not over allocating to a particular stock and you're not holding that position in that stock once it has completely run out, right? So, in a way, it helps you to avoid the concentration risk as such. So what you see on the slide is an example we have picked up, right? Again, this is from the the backtested period, and this runs from September 2019 to March 2023. What you see here is again the dotted blue line shows you the weightage in the portfolio. The red line shows you this time the price of the company. The company we have picked is eClerkX. So eClerkX was part of MeritorQ backtested strategy between September 2019 to March 2022. What you can see here is the stock had a meaningful allocation. Roughly around August 2021. In fact, its weight swelled up to around 11%. But in the in the September 2021 rebalancing, right? Once the stock price ran up the course, what we saw is it was no longer as undervalued as it was when we had picked it up in September 2019, right? And you can see the reason why. The stock price is almost appreciated, by some. I can't see it very clearly here, but if I'm not wrong, it has almost gone up twice, right, over the this period from September 2019 to August 2021. So as a consequence, as soon as you rebalanced in October 2021, the the weightage of e-clerks in the portfolio dropped, and it was cut down to around 4%. And subsequently, what happened is in FY21, the company also reported negative free cash flow, right? Again, going back to the point on fundamentals which I mentioned, the negative free cash flow around 550 crores, and this meant that it again was screening much more overvalued with respect to its own fundamentals, right? With respect to its free cash flow. So in the very next rebalancing, also in September 2021, its weightage was slashed from 11 to 4%, and in March 2022, it was removed from the portfolio. So it was completely removed from MeritorQ as such, right? So this tells you the importance of rebalancing again, especially in context of reducing excessive allocation to individual stocks, right? So what we have seen is as soon as the allocation towards a stock becomes too large, in fact, as soon as it becomes greater than 10%, what we have seen historically is as soon as it crosses 10%, generally in the next rebalance, the weightage of that stock in the portfolio, either it is reduced or it is completely removed from the portfolio, right? So it doesn't happen suddenly, but over the course of next two rebalance, what you generally find is as soon as the stock appreciates a lot and its weightage in the portfolio crosses 10%, either the weightage comes down and then subsequently it is removed. Right, this has been the experience as such, over the back-tested history. Okay, now on this slide again, we wanted to show you, more clearly what we mean by saying, picking up undervalued stocks regularly, right? Why the rebalancing allows you to pick undervalued stocks regularly? Simple reason is, we have taken because again for the selection rules and position sizing rules. But what this shows you is again this in action. Over again this period which we have chosen, right? Again, we have shown a 3-year period from September 2018 to March 2021, and what you can see here is over this 6 rebalances, each of these rebalances we have highlighted with a dotted circle, a dotted red circle, and you can see the weighted average price to free cash flow of the strategy in the month before and also the month after the rebalance, right? So you can see the actual numbers. For example, referring to just to the March 2019, you can see that the weighted average price to free cash flow was around 33.8 times before, 1 month before, so in February 2019, and 32.5 times after. So every rebalancing, you can see what happens is, and again, the weighted average price to free cash flow after the rebalancing, we have highlighted with a red font. And the one, the weighted average portfolio free cash flow of the strategy 1 month before the rebalancing, it is in the normal font, right? And every rebalancing, you can see there is a drop in the weighted average portfolio price to free cash flow. Why? Simply because of the portfolio construction steps, i.e., where we are selecting undervalued companies. So you're picking up, companies, with even lower price to free cash flow, and you're also giving higher allocation to such companies, right? So there's no wonder again your weighted average price to free cash flow of your strategy, goes down as at every rebalance, right? So one thing you would also notice that this picking up undervalued stocks this way does not work all the time, right? So if you think that again rebalancing and by picking this undervalued stocks regularly helps you enhancing returns all the time, it's not always the case. So for example, here between September 2018 to September 2019, this rebalancing wouldn't have helped, right? Or picking up this undervalued stocks wouldn't have helped. But obviously, like we saw in the previous two slides, there are other reasons to do the rebalancing, right? Which is to reduce your concentration risk and also to reflect any change in fundamentals. But obviously, when it works, picking up this undervalued stocks when it works, which is more often than not, and it is reflected in the overall returns of the strategy, it really works very well, right? Because it really enhances the portfolio return because you're picking up undervalued stocks, and as soon as the portfolio does well, you get the benefit, right? So it enhances the overall returns of the strategy, because you keep on picking up these undervalued stocks periodically, right? In fact, in 2020, again between this March 2020 to September or the end of 2020, the rebalancing really helped this strategy, and this portfolio, this is a back-tested portfolio, generated returns of around 32% versus 16%, 16.7% for Nifty 500, right? Which is a significant outperformance. So again, rebalancing doesn't help all the time. Just picking up of undervalued stocks doesn't help all the time, but it works more often than not, and it works when it is required, right? When it is really needed. Okay, now coming to the cost bit, right? So rebalancing, we have talked about the benefits, but coming to the cost, right? So if you think about the cost, immediately the cost for any rebalancing is the turnover, right? Which is the churn. And the turnover in MeritorQ comes from both overvalued stocks being replaced by undervalued ones, and also having their allocations, the relatively overvalued stocks having their allocations reduced. Now, turnover is a cost. It has both explicit and implicit cost. Essentially, the explicit cost is the transaction cost, the brokerage and the taxes, etc. And the implicit cost is the impact cost, right? So if you go and buy stocks, again, which everyone is buying, essentially the stock price runs up. So again, that adds up to your your overall cost of the trade cost, right? Even though you may not realize it. So frequent feedback which we have heard is that this approximately 55% average one-way turnover, right, which we have discussed before for MeritorQ, is rather high, right? What we are trying to show here is on the slide is that high turnover is justified, right? As long as it delivers the benefit in terms of higher returns, right? So what we are trying to show here is on the top half, right? The chart in the top half, shows you the returns of the 1 year trailing returns of this back-tested strategy, again between July 2006 to September 2022, and the red dotted line shows you the turnover of this strategy, right? And you can see, again, just looking at this the top chart, that in periods where the turnover was quite high, right? This is again the global financial crisis period, 2008, 2009, and during the Corona period, and there was exceptional volatility in the market. Generally these periods also coincide with, number one, higher turnover, but also higher returns, right? And it is the rebalancing in MeritorQ which helps you again to benefit from this, this higher return or enhance the overall portfolio returns, like we have discussed in the previous slide, because you're picking up undervalued stocks, remember. So your portfolio construction is dynamic. So as soon as there is a fall in the market, there's exceptional volatility in the markets, you pick up the undervalued stocks, which in turn do well, and then you get the benefit from the price appreciation, right? Now the table at the bottom, again, we have summarized this in a more concrete way by breaking up the turnover between again different we have banded the turnover across different values. So less than not able to see, but less than 25%, 25 to 30%, more than 30%. So anything more than 30%, you would say, again, we are just looking at the turnover at every rebalance member, right? So the overall average one-way turnover, again, in every year is 50%, right? But here we are looking at the turnover at any one rebalance, which you roughly expect around 25%, but sometimes it goes beyond 30%. So anything more than 30% is high, 25 to 30% is medium, less than 25% is expected. So, but what you see here is, again, we have also shown you the returns, during those the turnover periods, right? So what that first row is showing you is when the turnover at a rebalance is less than 25%, the returns are roughly around 16.9%, right? And there are 11 such instances in the full backtest period, right? And what you see is as your turnover increases, right? So less than 25%, 25 to 30%, more than 30%, and your average, the returns in the subsequent rebalance, the subsequent 6-month period, it actually also increases. So higher turnover is yes, it is a cost, but also it helps you enhance your returns, right? And costs are fine as long as you're getting the benefit, which in this case is the returns, which is what we want to emphasize, right? So obviously, if you're incurring a cost without any benefit, that's not good. But here, it is justified because it helps you with delivering the benefit, right? And again, all these numbers, right, especially the bottom table, I want to emphasize everything is over the 16-year period, July 2006 to September 2022. And if you add up all these rebalances, you would see that roughly comes to around 33 rebalances, which is 2 times a year you're doing. So roughly it's over the 16-year period, right? And again, all these are over a very long period of time. Right? So again, we are not we're not giving you stats, for just 1 or 2 rebalances or, over a certain period of time. This is again over the same period of time, which we have discussed all the while till now, the 16-year period. And again, just to, reiterate that point that, we should not just be looking at turnover as a cost, as long as turnover and rebalancing allows you to also enhance your returns. Now, finally, maybe just to sign off, we wanted to touch upon again this choice of semi-annual rebalancing. Why semi-annual rebalancing? Again, this is also a question we frequently get. What we have done on this slide is compared semi-annual rebalancing with 3 other choices you might think of. What if we had rebalanced the strategy annually, or if you had rebalanced the strategy quarterly, or what if we had just rebalanced the strategy once every 2 years, right? So what this chart essentially shows you is the 3-year rolling return on the y-axis versus the one-way turnover on the x-axis, right? Both turnover and returns are for backtested MeritorQ strategy again between July 2006 to March 2023. And like I said on the previous slide, higher turnover directly relates to higher transaction costs, right? So no doubt that turnover is a cost. So turnover, you can think of it as a cost, and rolling basically your y-axis essentially is the benefit, right? And ideally, you want to be then on the top left of this chart, right? Because that's where that's the zone where you get the highest return for the lowest cost or the lowest turnover. And this is where you can very clearly see that why semi-annual rebalancing frequency would be preferred, because it gives you a 3-year average rolling return of around 22.7% with a turnover of roughly around 50%. Right? So it gives you the best balance between turnover and the risk-adjusted return. Annual rebalancing is also lies in a favorable zone, but again we decided to go with semi-annual rebalancing to again avoid the excessive concentration, portfolio concentration risk, which we talked about earlier, and also because semi-annual rebalancing allows us to review the portfolio often, especially if there are unforeseen events or any adverse event related to individual stocks. So before I sign off, please keep in mind that semi-annual rebalancing or any other frequency we talked about does not mean that we actually hold the company only for 6 months. Right? Just to clear that misconception, what we are saying is it is basically the frequency at which we go through all the portfolio construction steps, which we talked about on slide 3. Right? In fact, the actual average holding period for a stock in the backtested strategy is around 2.4 years. Right? It's in fact higher than what you might imply from a 50% turnover number, because the 50% turnover number also includes not just your entry exits, but also the change in allocations, right? So either the change in the weightages of the stock, even though it's still in the portfolio due to buys or sells, right? So that's the reason the holding period is 2.4 years. roughly. Again, what we have seen historically, and which is what you can expect going ahead. Right. So I hope again this in this webinar I was able to convince you on the importance of rebalancing in MeritorQ and how it, like I said, it functions not just to enhance return but also to reduce risk for the strategy. Over to you, Alok.
Yeah, thanks, Christian. This is useful. So we already have a few questions coming in. So a couple of gentlemen are asking that how this strategy is different from our other buy and hold strategies, because Marcellus has always advocated that we should buy and hold for longer periods of time, invest into sound companies, and have low churn. So how come this strategy is different, and why rebalancing is important, which leads to a higher churn?
Yeah, so rebalancing is especially more important in MeritorQ. Remember, MeritorQ is a rule-based strategy, right? It's a quant strategy. There is little discretion, right? So unlike a a discretionary strategy where a portfolio manager is reviewing your portfolio or doing very deep research on individual stocks. Here we are not getting into that, right? Essentially, quant strategies, like we have repeated before, they their biggest advantage is the breadth, right? Essentially, because it's a set process and it's a very efficient process. So you can repeat the process. Essentially, it's a repeatable process. You can do the screening, the selection over a large number of securities, which in our case is the top 500 stocks in India, right? So breadth is an advantage, or the breadth of securities is an advantage for quant, right? And when I say breadth, it also means being able to repeat the process often, right? This is also more efficient from a quant perspective, right? So rebalancing then is an absolute requirement, right? Because it leverages the the biggest strength of quant, right? Secondly, when you think about rebalancing again, for a product like this, especially for investors, and this again, when we talk about this product, this is mainly geared towards investors again who might have their own time horizon, their own investment horizon. What a frequent rebalancing allows you to do is, first of all, like we said, right, it reduces risk, reduces excessive concentration to individual stocks. It also allows you to reflect change in fundamentals. So all this allows you to reduce drawdown. So just going back to this the slide which I showed. So when you compare the drawdown of this of a rebalance strategy versus a buy and hold, you can see that there is a difference, right? So especially the difference between, say, when I say the rebalance strategy, essentially it's the last column of the left table. You can see that the maximum drawdown is 35.6 versus 39.5 for the 5-year buy and hold, right? And it's also lower than the 3-year buy and hold, right? So that tells you that again, for someone who is investing in this product, who has a time horizon of 3 to 5 years, for them to avoid so if they have a 3-year horizon, at the end of 3-year horizon, if there's a drawdown like this, right, a rebalance strategy would help you to again realize better returns than a simple buy and hold strategy, right? So again, this rebalancing is also important from an investor point of view, just to avoid any basically for you to avoid any negative return event, or realizing lower returns simply because when you invested and when you're exiting out, right? So basically rebalancing reduces the timing risk from the investor point of view, right? So both from reducing the timing risk from the investor point of view, as well as like I said, reducing, because it's, it leverages the benefit of quant, the strength of quant, again, for both these reasons, rebalancing is important in MeritorQ, and rebalancing is also then, a distinguishing feature of the strategy, which, obviously that's the reason this is absolutely a requirement, and why it is also different from what you might typically be used to on the discretionary side.
Right, Christian, this is useful. So one related question. So whether higher churn will lead to higher returns always? For example, your slide 10, turnover was quite high in 2019, but the portfolio returns were negative.
Yeah, so like I said, I mean, higher churn will not always lead to higher returns, right? But yes, what the table at the bottom shows is there's a higher probability, right? So there's a higher chance that higher, churn or churn due to rebalancing will lead to higher returns, and there's a difference between the two. We're not saying always it's going to happen, or irrespective of anything, it's going to happen. Otherwise, everyone will be doing rebalancing. It also depends, the kind of strategy you have, whether rebalancing is apt for that strategy. In case of MeritorQ, our point being that, because, the construct of the strategy where we are picking up undervalued stocks, and because it's a quant strategy, like I said, and also because of the other risk mitigation it also offers, it is more often than not, when rebalancing, comes into play, and especially during times when it causes higher turnover, it does lead to, it does enhance the overall portfolio returns, right? More often than not, like I said, right, but not always.
Got it. So now on your slide 9, you have created a few buy and hold portfolios. So one gentleman is asking, why haven't you done it for the whole back-tested period and only for specific periods?
Yeah, so we could have, but again, that would have raised questions on. First of all, it's impossible to create 3-year buy and hold. You have to do it over again multiple. You have to create multiple portfolios, right? So that's one. And the reason we didn't do it over the entire period is because a simple buy and hold portfolio just starting from July 2006 to September 2022 is again it obviously raises question on the choice of the starting and the ending period, right? So instead we have generalized this analysis where we are doing this over multiple 3-year and 5-year periods. Then we've taken an average, right, which is more representative for what an average investor experience would be, rather than just taking an arbitrary start and end date.
Okay. Now, so is there a way to ascertain what could be the drag on returns from the impact cost of trading? So we do this rebalancing twice a year. So what could be the impact there, because everybody could be rebalancing at the same time? Right.
Now look, it's yes, it is a cost, right? But remember that in small case, again, this how the rebalancing works. It's not necessary that, and I don't think it's possible, or I don't think it's all the investors put in their rebalance orders all at the same time, right? So notification goes out. So for example, if notification goes to your phone and my phone, I might be rebalancing it, say, over any time over the next 1 week. You might rebalance at a different point in time. So impact cost comes into play when, first of all, the orders are very large, right? When the trade sizes are very large, which in this case, I don't expect it to be. And also if all of us are, executing these trades at the same time, right? So neither of which, again, is a it's a very common occurrence, at least, the way I'm thinking about it. So at least for now, the risk of, this drag due to higher impact cost is less, right? Obviously, at a future point in time, where we feel that, this product has, gathered enough scale, right, where impact cost will be meaningful for any investor, then we would take an appropriate action in terms of, maybe adding a rule around liquidity, or just to make sure that investors don't suffer from impact cost drag. But as of now, this is less of a concern.
Got it. One question on rebalancing is there a bifurcation that how much churn might happen during the March rebalancing and how much churn might happen during the September end one?
Yes, so it's mostly balanced, right? So that's what we have seen. The September rebalance, like I said, it reflects both your fundamentals as well as your the change in relative valuation, right? So the churn is slightly higher in September rebalance, but broadly what we have seen is it's comparable, right? So it's not that you'd end up incurring a lot of churn in any one particular rebalance date. It's just slightly higher in September. Again, most of our fundamental screens, they don't change a lot, right, year to year. And like we have discussed before, because they don't change a lot, the contribution to turnover from change in fundamentals is relatively less, right? It's the change in the relative valuation which causes most of the churn, and that holds true for both September as well as March rebalance. It's not much different, so it's fairly balanced across both the rebalance.
One common question that we get asked is, so we do it only twice a year, but in case there is any negative news during the course of the year, then what happens? Do we ask the clients to sell in between, or we still wait for the rebalancing date to come in?
So, if there is an adverse event, generally, we don't take any portfolio action, right? So I don't know what we mean by adverse event, but generally, given our portfolio construction steps, and we have repeated this in the past, right? Given our steps, forensic screener, leverage screen, and also remember, we also have a manual review of the portfolio at the very end. Given these steps, we don't expect any of the stocks in the portfolio, to ever face or to get into the situation in the first place, right? So we avoid, we would like to avoid, getting into situation in the first place. We haven't seen this even in the past, but going forward again, like we said, we don't intervene or in the portfolio due to some rumor or some news on which it is very difficult to form any conviction on, right? So no action as such, to answer your question. Now, in case of corporate action, for example, if a company has announced delisting, or a company has announced an M&A, especially in case where it's not a surviving entity, it's taken over, it's either going to be taken private or either it's going to be merged into some other entity. In that case, we might take a call and just remove that company, because again, as soon as this, generally what we have seen is as soon as such a news comes out, it gets immediately reflected in the prices of the company, the stock price, right? No point in again for investors to hold this, till the point we see the end of the transaction. So we might take a call and just remove that company from the portfolio and just redistribute the allocation pro rata among the rest of the stocks, right? But barring these, really very infrequent corporate action events, we don't intervene between the rebalance.
So a couple of questions on the performance. So one is the back-tested results are shown gross of fees and taxes. So what can a customer expect, maybe on a net basis, just a rough idea. The related question is around a comparison with the benchmark. So what is the probability of this fund beating the benchmark over the designated or the say suggested period of investment?
Right. So coming to the first question, we don't have the the net returns here. The simple reason is, look, the of course, you can make some, you can guess estimate on the amount of transaction or brokerage cost you might incur, but again, that also tends to vary from depending on the brokerages you have employed. Secondly, taxes, etc., also depend, right, on when the investor invests in the portfolio. It depends on your your horizon over which you're holding this strategy. So again, that's the reason it's very difficult for us to generalize these costs, right, when we are showing the returns here, at least, right? But like I said, and of course there's a fees element also, which we you can compute on your own and calculate the net returns. The fees, by the way, we have a fixed fees right now, 20,000 per year. So you can take that out when you calculate for calculating the net returns, or what you might realize. And coming to the second question, this we again, it's very difficult to give any probability or any number on what the chances it could beat the benchmark. What we can say is, again, we have shown you the back-tested returns, and again, remember the back-tested strategy is using point-in-time data, right? It uses the data at that point in time and we create these portfolios and we rebalance these portfolios over the 16 years, right? Using the same sequence what we are, going to do going forward. So that gives you a very realistic idea, right? What you might expect going forward. Back-tested returns, you can see on this slide, that's roughly 22%, right? Over, this is an average 3-year rolling return. Again, please note that the returns here are in gross terms, right? We haven't taken out fees or any transaction costs. And this 22% return broadly compares with the 8% return which you see for an equal weighted BSE 500, which is your investment universe, right? So though it's very difficult for me to give a number, what the chance is, going forward, what chances it could beat the benchmark. What you can see here is at least over the 16-year period, if you just look at the 3-year average rolling return, there's a good chance, just looking at these numbers, there's a good chance that it would beat the benchmark going forward also. Unless obviously something radically changes, right? Which means that people no longer buy securities or prefer companies which are generating free cash flows or which are profitable. Which again, I leave it to you whether that's a realistic scenario or not.
Right. So another question on rebalancing is whether the monitoring of these companies happens on a real-time basis, day in and day out, or these are just monitored before the rebalance?
We do monitor the companies, like I said, for corporate actions. Right now we are not monitoring for again news or any adverse developments, like I said. So for all practical purposes, the review of this portfolio happens as of now for the extent rules. It happens only on those rebalance dates.
Right. So, sir, there are a few stock-specific questions, but I would like to reiterate that please consider this portfolio as a whole, because this is a basket of a few companies, say 30 to 40 companies, and we have taken certain rules into account before creating this portfolio. So it will not be right to look at stock-specific. So we do not research individual stocks before creating this portfolio, but it is a basket of portfolio. Maybe Krishnan can add more on these lines.
Yeah, so this is a portfolio as such, and again, it works only if you buy the full portfolio, right? For the advice, the advice is which we are giving is not for individual stocks; it's for the portfolio, right? The allocations or the number of shares to buy is also based on all the steps which we have talked about. So again, it's not recommended that you pick and choose stocks here, right? And even the stocks we have discussed, please note that these are for illustration and for understanding only, right? They do not guarantee any future returns, and we are not asking or recommending that you go and buy these stocks, for sure not.
Right. There is one question on whether to do some kind of SIP into this portfolio. What's your advice on that?
Yes, I mean, SIP is a good option, especially if you are saving regularly and you don't want to, again, the problem with lump sum, I'm sure, most of the people who are listening on this call would be aware that, there is a timing risk, a timing element. It might work out well for you, if you time it well, but, it might also go against you if you don't. So, for people, especially who are earning regularly, who have a regular stream of cash flows, who save regularly from, their monthly earnings, it is recommended that you go for the SIP option. It obviously inculcates that, the saving habit at the same time reduces this, the risk of you having to time your, your entry or, time your buys of this strategy, right? So in that way, your return would also be accordingly be smoother, right? So yes, it's a recommended mode of for you to invest here.
Right. So, Krishnan, we have covered questions. I think I'll quickly just take them through how to invest into this portfolio.
Yeah, I'll stop sharing.
Yeah, sure. So I'll share it. Is my screen visible? Hi, Krishnan. Is my screen visible?
Yes, Alok.
Okay. So anybody who wants to subscribe to this portfolio or needs more information can go to our homepage, marcellus.in. On marcellus.in, you can click on this button, Invest Now. You will find option of Investment Advisory Services. When you click on Investment Advisory Services, it will open the MeritorQ page for you. You can download the product presentation from here if you want to understand more about this. We also have a quick infographic here, a short infographic wherein you can understand the strategy in a better way. And once you decide to invest in this, you need to click here, Start Investing. This will take you to the small case website. On this website as well, information is available about this portfolio. So the minimum investment amount is dynamic. Currently, it is 2,08,000. Approximately, it will be around this 2 lakh mark. For more details, you can click here on Marcellus MeritorQ. You will be able to find some more details here. So I'll just quickly share some. So this is the recent performance of this portfolio, which can be seen here. Once you decide to invest, you can click on Subscribe Now, and it will take you to the actual subscription page, and you follow the steps there. You can start with putting in your email, then select the plan, add a billing information. Then you will have to sign the agreement by using your Aadhaar with the help of the Aadhaar OTP. Then pay the subscription fees. And then the portfolio will be visible to you for investment, and you can invest it at a click of a button. If you have any queries around the product, you can write to us on help.ia@marcellus.in. Or if you want to understand the execution better, you can go to the FAQ section on the small case page. Right, so with this, we come to the end of this session. Thank you everyone for attending this session, taking out time. As I said, if you have any queries, we can reach out to us on help.ia@marcellus.in. Or in case if you have platform related queries, you can reach out to publisher.help@smallcase.com. Until next time, thank you so much for attending this. Thank you, Krishnan, for attending.
Thank you.